Good morning. Welcome to our latest live chat from Stearns Financial. I'm Dennis Stearns, and I'm joined today by Glenn Joyce, our Co-Chief Investment Officer. And we're going to be talking about all the things that are going on in the world, but of course we don't have time to talk about all that. So we're going to try to narrow it to more the investment areas post-election and with some of the COVID news thrown in. And today we have a little different chat feature. We need everyone who has a question to email it to us at stearnsfinancial@stearnsfinancial.com. And we will be monitoring those emails as we go. And we'll get those up for frequently asked questions. We already have a few that have been sent in ahead of time. So let's get started. And so some of you may already are thinking, is it really post-election? Well, we're not going to get into all of that drama that is going on right now. But for the most part, I think the markets are viewing, the stock markets in particular, are viewing the election results as over and the future as being one of a split investment and election landscape, meaning that the Republicans will likely hold on to the Senate. Now that's still up for grabs, as we mentioned in our last written chat. That's up to Georgia and the two Senate runoff races there. But several of our pretty tuned in research sources believe that there's a very high probability at least one of those will go to the Republican incumbent, and that is likely to maintain the Senate in the hands of the Republicans and the other two branches of government in the hands of the Democrats, which takes one of the thread the needle pieces off the table that we've been talking about in recent chats, the potential for a tax increase in 2021. So let's go to that next slide. And so this thread the needle, which in our last written chat, we said maybe it's not a needle anymore. Maybe the eye of the needle is becoming much larger. But when we first talked about this, we were saying that if we had lower for longer interest rates combined with COVID-19 relief in early to mid 2021, mostly via good vaccine opportunities, combined with a split election, meaning no corporate tax increases, combined with no geopolitical surprises overseas in particular, then maybe 2021 had the prospects for a pretty good recovery. And Goldman Sachs and several other entities have put the odds of this now at greater than 70%, the combination of these factors. And again, the check mark items are the ones that we already have some good progress on. The lower for longer interest rates, accountants like to put 2 check marks when something has been verified. And so maybe that one should be 2 check marks, lower for longer. And again, that's a relatively recent telegraphing by the Federal Reserve on their inflation policy going forward. How long will we have low interest rates? Nobody knows. 3 years, maybe longer. And so that creates a lot of opportunity for cash, which there is a massive amount of cash in the hands of retail and institutional investors, not to mention private equity funds. I mean, we're talking trillions and trillions and trillions of dollars of cash, and that's not a misstatement. It's trillion with a T, not billion with a B. So there's a lot of cash looking for something that'll provide some return and some yield. And again, lower for longer interest rates takes a lot of the traditional things off of that table and puts a few of them back in the stock market. So that certainly is a positive tailwind for a number of stocks. The COVID-19 relief, we're going to get into that a little bit more. As everyone knows, there's been some positive news in that category. And some of our network sources say maybe we ought to have 2 check marks there. I don't know that we're quite that brave to put 2 check marks there yet, but it's certainly trending in the right direction. And then the split election, again, that seems pretty likely. Now, we still don't have 2 check marks there, but it still seems pretty likely that this is going to be a split election. So there will not be a corporate tax increase, very likely, in 2021. The no geopolitical, you'll notice there's a question mark beside that one, because that one is one that is clearly a question mark. And there are a lot of things bubbling all around the world. And so we'll have to see if that one clicks into place as well. And so this scenario, again, trending positive, and maybe that eye of the needle is more like a narrow tunnel. It's certainly becoming larger. Let's go to the next one. So Glenn, let's talk about the investments results year to date in a variety of different categories.
Yeah, Dennis, I will follow up on one comment you made. I think it was Morgan Stanley back in the early part of this year estimated that the cash on the sidelines, or at least cash in money markets, was around $4.7 trillion. So back to your point, we've seen a lot of buying on the dip. So whenever there's been weakness in the stock market, we've seen people come in and buy and keep this bull market going. And so definitely that's something to consider as we go forward, is that kind of dry powder on the sidelines potential. But to this chart, the asset class returns, you may recall we had a podcast, I think it was just about a month ago, back in probably early October range. And we were showing the returns on this asset class chart through the end of September, the first 3 quarters of the year. And at that time, and we like to focus on the year-to-date column, third from the right, at that time, there were really only 2 asset classes that were positive, outside of cash being just above water, your return on your cash investments. And it was U.S. stocks, or the S&P 500, and it was the fixed income core bonds, the Barclays aggregate. I think both of those were the only 2. And we were talking about just the lack of breadth in the market and how diversification really hadn't worked so far. But as you look at this chart, updated, and so we're looking really through the first part of November 6th, I believe, and you can see how things have improved, and we are seeing more breadth. U.S. stocks is still the place to be, at up about 10%. But notice how emerging markets have really come on. So areas like China, Brazil, these emerging economies, we've seen a lot of momentum on the stocks in those areas. And so fixed income still been a good place to be, but we have seen a little bit of a rise in rates post-election. And so we don't expect bonds to give you anywhere near 7% going forward. We think it's more reflective of their yield. But I think the main story here is we're just seeing much more broader participation among asset classes. There's still some at the bottom that are not doing well. And I think we'll talk more about maybe opportunities in some of these kind of beaten down names, or names that haven't really participated. But I think we are very pleased to see diversification at least helping more, and seeing some of the international areas start to compete much more favorably in the last few months. And some of that's been dollar weakness here in the U.S., which is also usually a tailwind for U.S. investors when they're investing abroad.
Yeah, and I think it's interesting, Glenn, that asset allocation white box, that again, well, who would have guessed that the stock market in the middle of this pandemic would be doing what it's doing, but who would have guessed that the asset allocation diversified piece would be positive in a year like this?
Yeah, that's a great point. I mean, that's a portfolio that's generally around 2/3, kind of stock-related investments, and the rest are more diversifying asset classes like bonds and real assets and things like that. And so, I think you can just see when you kind of blend all those asset classes together, that's the reason why it's only up about 3% so far this year. And this is a JP Morgan portfolio. This is not our portfolio. And so it just kind of speaks to, we're seeing that improve, but some of these bottom areas are kind of keeping the returns a little more muted. So good point.
Okay, let's go to the next one. COVID confirmed cases and fatalities, always a fun topic.
Yeah, we've had this, I think, in about every chat, I believe, and it's been obviously at the forefront of everybody's minds, is the rise of COVID and the spread. And, I think we are seeing a surge. You can see by this chart, if you focus and just kind of look at the lines here, especially the blue line, you can see the big surge we've had since late September up through November. And so that's not good. Obviously, we're seeing more cases. I think we've got in the U.S. about 10.5 million people have been impacted or infected by this. And the death rate is now, I think, a little over 240,000. So rising towards, 250,000 people. So definitely a very unfortunate deal. And we're all trying to figure out how to move forward safely. I guess the silver lining, I think, is we have seen the fatality rate, that the brown line. You can see that this is really looking at a 7-day average. So basically what we're saying is the surge on the blue line is we're getting about 120, close to 120,000, not quite that, per day, is at least the last 7-day average. And on the fatalities, it's actually trending higher, but not nearly as much as on a percentage ratio, or at least a basis of the cases. And so that's been the good thing. We're getting about 1,000 or so deaths, which is very, very bad, obviously. But I think the fatality rate was probably closer to 2.5%. A while back, and now it's getting to be where it's getting below 1%. Some of the reasons for that, I think, are that there's more testing, obviously, so more people are finding out they have it. Also, treatments are helping out in terms of helping, and people are just learning how to deal with it. Our hospital workers are helping with treatments and just figuring out ways to give patients a fighting chance. And it's a younger group now too. The average age has been dropping because it's impacting a more broader segment of the population. So, it's definitely not a good picture, and we're obviously continuing to monitor this, and just hoping that the news Dennis mentioned, and we'll talk more about the Pfizer news and some of the vaccine news coming out. Hopefully we can kind of just continue to get some positive news on the front of dealing with it. And once again, it'll stay something we'll monitor closely and keep you guys abreast of.
Yeah, and I think a couple of other comments here we've mentioned in past written chats that there's a frequently asked question has been, well, how can the stock market go up when COVID rates are going up? And the answer is really simple, that COVID has an impact on some industries more than other industries. And so, yes, if you're a restaurant, that's a big problem. Although one of the major restaurant stocks is actually hitting all-time highs, which is a bit of a head scratcher for me. But other parts of the economy are not impacted nearly as much, and so that's part of the equation. The danger point here that we've been hearing from our infectious disease network is that some of the hospitals are starting to get filled up. And if that Morningstar research that we shared in our last written chat is correct, that the number of people infected will go from the number you mentioned, Glenn, over a little over 10 million to over 20 million people will have had it in this country by the end of the year. That's going to be daunting for certain healthcare parts of our country. And so then the question is, will people be getting or able to get the same level of treatment that they would have had if the hospitals are full? And there was a picture yesterday on the news of Naples, Italy, where they actually had cars lined up outside the hospital, and people were being treated in their cars. As crazy as that sounds, there was a line of cars with people being treated for COVID in their cars. So good news is that some of the healthcare folks we work with, they have other solutions they've already set up early in the pandemic. So hopefully there won't be lines of cars around your hospital. But again, this is something to keep an eye on. Next slide.
Yeah, so I think that's a good segue to this slide, Dennis. I think, when you think about the Pfizer news earlier this week, and kind of back to your point, we definitely seen Germany and France go back into some limited lockdown, at least on some of the more public industries. And so that's been unfortunate. So that is the big concern is, do we take a step back here with the opening up of the global economy? But the Pfizer news was a very a positive piece earlier this week, and they, along I think with a German company, announced this week that we're always talking about will the vaccine be effective? Will it be safe? And so they have had more cases, obviously, to do testing on, and given the spread. And I think they pretty much said that right now it's tracking at more than 90% effective on the sample group. And so that was received very, very favorably, I think it was Monday, by the markets. And so we saw a lot of the social areas, some of the beaten down areas that had been more dependent on gathering and getting back in a social construct, they really rallied hard. And so maybe that gave us a little bit of a glimpse about, if we do get this vaccine and we can get it distributed, what areas of the market might participate more fully. And so it could be a little change in the guard potentially. But I think, we'll turn here in a minute to distribution, but I think Moderna is using a similar approach. And, I think we've got about 9 companies, I think, in the final stage right now of a vaccine. So there's a lot of, momentum out there. Now, obviously, every person's got to make that decision about, do they feel comfortable taking it? But at least it's definitely a positive development, and something that will be an option for folks, we hope, much sooner rather than later.
Yeah, and we should mention our usual caveat. These are not stock recommendations. So we are not recommending Pfizer or Moderna. And as a matter of fact, usually by the time you get to this stage, things have been bid up to the point where future potential returns may be more muted. So buyer beware. And I think it's also interesting, we have some friends of the firm and a few clients who are actually in the Moderna clinical trial. And so they've already taken the vaccine and the booster, and no major serious side effects, and antibodies are up. And so again, I think there's some reason to be positive about this general category. Let's go to the next one. So so that it's simple, right? All you have to do is manufacture it and distribute it. No big deal. But is it really that simple, Glenn?
Yeah, I think that's going to be the next big hurdle, obviously, is once we get the green light, is getting it out to people. It's interesting. Pfizer, I was reading, they've got 2 facilities. One is in Kalamazoo, Michigan. That's not far from my wife's hometown. And so that's a big facility up in Michigan that's producing this, and or will be in production. And the other one, I think, is maybe in Belgium, I believe. And so I think Pfizer has targeted about 50 million doses now, or 50 million, by the end of the year is kind of their target. They feel like that's reasonable. I think you have to take 2 doses, though, per individual. So that'd be cutting it down to 25 million folks. And if you divide it in half, half being produced outside the U.S. in Belgium, half here in Michigan, maybe 12.5 million people per United States versus abroad. So, that's, less than, what's that, about 3% or so of the population, a little over that maybe. So it's something that's going to take some time, obviously. I think FedEx, UPS, they're on standby. And so, I think you got to keep it, on dry ice, like negative 94 degrees Fahrenheit. So it's going to be something that's going to take some orchestration to get this out. But I think that will be obviously the focal point once we do get at least an approval. And I think it'll be very interesting to see how we decide who gets those dosage. Obviously older people are more at risk, and I think we'll just have to kind of see how that plays out. I don't know, Dennis, you have any other thoughts there?
Well, yeah, I think the new administration has already telegraphed the distribution plan, and that distribution plan will follow the CDC guidelines. And so those CDC guidelines, which are on their website, are fairly straightforward. They're what you would expect. So first responders will be able to get first dibs on that. People who have pre-existing conditions that make them more susceptible to bad results from COVID, which probably means no one under the age of, well, certainly 50 would be less likely, unless there were, again, some pre-existing conditions and that person was somehow in a critical industry or first responder. So, that's why we have said in our written chats that sure, there may be 1, maybe 2, maybe 3 vaccines that are distributed in the first quarter of 2021, but the real momentum is probably going to be more in the second and third quarter of 2021 from a manufacturing and distribution viewpoint. And fortunately, not all of them appear to need the super cold dry ice solution for shipping. So Glenn, this is showing unemployment and the recovery in employment. So tell us what we're looking at here.
Yeah, so this right here is definitely looking at the employment picture. And if you look, maybe starting on the left chart, this is looking at kind of private payrolls here in the US. And probably the big takeaway is if you look at the little index or legend, you can see we essentially wiped out 10 years worth of employment gains dating back to well past 2010 in a couple months. So that definitely, the lockdown has really been a disruptive force, as we all know. So it's nothing to laugh at. We still got, even though we had a V-shaped recovery, as you can see, during the first half, to get back halfway, the second half is probably going to be more gradual, unfortunately. And I think that's given that we are into the areas, as we'll see as we shift over to the right chart, the areas that have been hit the hardest, like leisure, trade, education, health services, even some of the professional business services on the left bottom part of the chart. You can see those areas have still got quite a bit of recovery left in them to get back to full capacity. And so, you know, we can do Zoom, we can do some of these things we're doing today and use technology to try to help us move forward. But unfortunately, some of these areas do rely on social gathering. And so that's the reason why the vaccine news was pretty positive for some of those areas, some of those stocks in those sectors, at least on that initial news. Is, and it'll be very interesting to see how that goes forward as we get more clarity around the vaccine. But it's, once again, this is a very nuanced recovery. It's going to be something that's going to, you know, be depending on where you are. And so fortunately, if you're in areas where you can rely on technology, then it's definitely beneficial. But others maybe in areas that rely more on social gathering haven't had it nearly as good. And that's very unfortunate.
Yeah, so this is something we're going to have to keep an eye on. You know, we've been saying from early on that it would be a nuanced and uneven recovery, possibly one of the top five in in modern history, certainly during a recession. And again, you normally don't see that chart on the left. You don't see so many jobs vanish. They didn't really vanish. A lot of those were, you know, temporary, and then suddenly return quickly. In fact, you can't even hardly on that chart see the line coming back up the other direction. So we are living in unusual times right now. Next slide. Yeah, so this is back to your point, Glenn, about Monday of this week. We had an unusual, a very unusual, in fact, parts of it were we haven't seen in 25-year event. Talk a little bit about that.
Yeah, so if you think about just kind of technology's been the leader in the market for a while now, and technology stocks were really accentuated, I think, at least in my estimation, during this period from working from home and just at the lockdown period and while we weren't fully up and running as an economy. And so technology generally, or at least a lot of the parts of technology, were able to move forward and help us. And so that sector's done really well. It's recovered and moving higher. And you know, we've expected more from some of these areas maybe going forward that have been beaten down. I call it kind of the haves and the have-nots. The have-nots, you know, banks. You're talking about areas of the market where they're leisure travel, where they're just, once again, these are areas where they're relying on people, you know, getting back on cruise ships, going to Disney World, you know, doing things socially, you know, the restaurants, et cetera. So what was very interesting, as Dennis mentioned, was when we had the Pfizer news, you know, some of these areas that tend to do well when the economy is really, when people are confident the economy is back off the training wheels and is starting to recover. And that would be things like smaller cap stocks, that would be, you know, small company stocks. It would be things like, you know, the financials, given that everybody's concerned about maybe some of the issues there with loans and just whether they're going to be able to get everything back in terms of what they've loaned to smaller businesses and folks that have been impacted by all this. And then once again, just these leisure travel areas or things that are more tied to us getting back to full speed. So I think the big question in our minds is whether this glimpse of the rally that we saw in some of these areas that hadn't participated as much during this past year or so, is this going to be something we're going to see as we do get the vaccine news, that we do have the green light, and as we start moving forward and hopefully treating people and getting through this, will we see a transition or a change in the guard from some of the growth areas to maybe more the value areas and some of the areas maybe that are socially dependent?
Yeah, and again, we have chronicled in our written chats many times how this is one of the very unusual recessions, also from the standpoint of which stocks did best and which stocks did worse. Most recessions, value stocks, dividend growers, other kinds of lower price earnings ratio value stocks do better in a recession, and growth stocks usually don't do so well. And it was exactly reversed. And so, again, the question is, when we start to see the COVID endgame coming, will it reverse again? Maybe not. And we'll talk about that. I mean, we certainly think that some of these value stocks will do well going forward, but we think there's a place for growth as well in the techno-industrial revolution. So let's go to the next one. So what does this little equation mean?
It's interesting. We talked a lot internally at Stearns about the narrative and how the narrative has changed. And it seems to be the market is just looking for a narrative that's upbeat and suggests we're going to get through this sooner rather than later. Because if you may recall back, before the election, Trump was seen as, business friendly, kind of let's break the rules, let's just do things more, business focused, and it was good for the stock market, right? And then as we started seeing Biden's lead, at least in the polls, if, once again, the polls were the polls, but at least when the lead looked like there might be a blue wave post-election, the thought was, well, there's going to be more stimulus. So that's good for the market, and more stimulus is something you want to lean into, because whenever the Fed drops rates or whenever the Federal Reserve, goes through this quantitative easing and stimulates the market, stocks usually do well in that environment. So now post-election, and once again, we're still kind of finalizing Georgia and I guess the Senate, but it looks like it's going to be kind of status quo, perhaps, with a split government, the presidential piece will change perhaps. So if Biden's president and you've got a split Congress, it's really kind of status quo in some regards, at least, from the divided Congress piece. And does that mean that we'll get stimulus, but it'll be a little more muted? And the narrative on that may now be, well, that's actually good, because we're going to get some stimulus to get people through these tough times and focus on short-term considerations. But then looking out the long view, it's like, well, we want to make sure the fiscal health of the economy stays strong. We don't want to have too much debt. So now the narrative seems to suggest that with status quo is good, and the stimulus is going to hopefully be the right amount. The Goldilocks stimulus, not too hot, not too cold. But yeah, it's very interesting how all that's changed. And I don't know if you have any thoughts on that chart.
Well, I think the good news here may be that because the thread the needle scenario is becoming more positive for the economy, that suggests that we don't need stimulus to keep us going into a double dip recession. And that really is one of the concerns that's been out there. And again, last 30 days, some things have changed in terms of the vaccine picture and interest rate picture and other things. And so maybe we don't need as much stimulus to keep this economy going. People like Larry Kudlow were out this week saying, we're in fine shape in terms of recovery. So and I don't think in that particular case he was talking any particular political position. So I think let's get on to the prognosis for the stock market. So this is the chart we have shared a number of times about short-term, long-term prospects for all kinds of different asset classes. Glenn, walk us through what we're looking at.
Yeah, I think the big takeaway here is that there's certain areas of the market where we do want to kind of lean into the momentum and kind of make hay while the sun's shining, I think. And so it's not that things look great, but I think when you do feel like the recovery is going to come forth, and once again, it gets back to the speed of the recovery, we want to think about those major asset classes at the very top and kind of how we're positioned amongst like stocks or equities, fixed income, and cash. And when you look at this chart, what it's trying to do is kind of give you, the view on these asset classes, in terms of whether you like them. If you like them, they're going to be more in green, which means you want to accentuate overweight and you think they're going to do better than some other areas. And if they're more in the kind of beige, or that's more neutral, and then red is not so good, and you want to underweight or try to shy away from those areas more than normal. And I think the message is that it's not like anything is super exciting near term. 4 is about as high as you see when you look across global stocks, and you can see the big picture on equities. It's really just 3 when you kind of marry all that together. Bonds are bonds. They're more there right now, I think, for stability and diversification, not that we're going to look for really strong enhancement of return. But as you start shifting out the longer term view, it can get a little more challenging for some of these areas. As Dennis mentioned, the vaccine, if that gets us going and we can kind of get this economy open back up, it's going to be interesting to see if the stock market continues to move forward. And it gets back to, where is the growth rate of the economy and how do things look on the other side? Are we just back to a point where stocks may look a little bit overvalued and we're back to a growth rate that may not be, much more exciting than it was back in February of this year? That's the big question mark. And so if we get to a point there, we really need to see where we are with the growth rate of the economy, judge the valuations, but at least, from where we're looking today, it may be a situation where stock returns, once again, given the strong 10 years that's just transpired, they may look a little bit below average. And I think in bonds, for sure, as long as interest rates stay low, it's going to be tough to expect a lot on the bond side of the equation. So once again, this is part of the reason why we're trying to incorporate additional asset classes, additional tools. You may see some areas, the global area, maybe a little bit better for stocks, as you can kind of see on this chart. So we may want to lean in a little more to international stocks. And once again, that's a little bit forward looking because they haven't done as well in the past. So we got to time that and try to figure out when's a good time to add more there. But overall, I think when you look out longer term, the areas that are the highest ranked, you can look and see, gold is one. We do have gold in the portfolios, at least more in the growth and conservative growth. And income folks. And then you start thinking about other areas where there's inflation protection that may take a little bit longer to play out. And emerging market stocks continue to be an area, if you do believe they're going to continue to drive the incremental growth story. But it's really tough right now to just think about the risk and the return and just have a table pounding conviction about any one area right now.
Yep. All right, let's go on to the next one. So value in international versus a better recovery, hopefully a better economic and COVID recovery in the US. Tell us about what this is saying.
I think here what we're talking about is international has, for a while now, you've always generally got a discount on international stocks versus US stocks. Some of that is because we're perceived to have better, governance, just more controls, especially when you're comparing with like emerging market international stocks. But in general, you've always seen a little bit of a premium for US stocks. Now, going forward, that premium has been kind of narrowing for a while now. And so going forward, we're really trying to think about, are we getting enough discount in our national area to justify it as more of, maybe not a fat pitch, but an area we want to definitely start focusing more on. And I think right now we are seeing international, I got this chart coming up that's going to show it's trading at a very significant discount, even historically. And so I think that's the challenge. Here in the US, we've had just very strong performance. The US, when you compare our economy versus some of the other global regions, looks pretty good. It's relatively strong compared to some of the others. And we usually have more control over our destiny as opposed to a Europe where you have a lot of different constituents. You got to get everybody to buy into certain things there for a consensus. And so I think we have a lot going in our favor, and it's going to be a question that when that transition unfolds, and this chart does kind of get to it. You can see here on the left pane, emerging markets, looking at valuations there on a price to book ratio. And you can see that it's a very low point when the line's going down at a -1 standard deviation almost, or getting close to that. That's really saying that emerging market stocks look relatively cheap. compared to S&P 500 or US stocks. And then if you go over to the right, you see now we're looking at developed markets, so not the emerging markets, but the more mature economies like in Europe and Japan. And the story is even a little bit stronger there. Now, once again, we do know Europe has its issues. And so, once again, you got to think about the economic risk, the political risk. But when you look at purely the valuations of the stocks, it definitely starts to make you think we need to start really thinking about how much international investments we want to have in our portfolios.
Yeah, it was interesting a few weeks back in our written chat when we had included the chart that showed the combined value of the big tech stocks, the Microsoft and Amazon and Apple and Google and so forth. And those 6 stocks represented more value at the time of that chart than the entire stock markets of the Pacific Rim, which include China and Korea and South Korea and just a whole variety of other markets, and almost as much as the combination of Europe. So it was interesting. Some of our clients, their first takeaway on that chart was, "Oh my goodness, those stocks are going to drop in half." And then some other clients, the takeaway was, "Oh my goodness, those are U.S. companies that are really good at innovating, and they should be darn well worth it." Well, interestingly enough, there's truth in both of those statements, and that's what you have to kind of sort out today is in the techno-industrial revolution. Okay, let's go to the next equation. So what does this equation mean, Glenn?
Well, I think when you start marrying all this together and you think about, just where we're going to hopefully start getting through this with a vaccine, and just thinking about where we are with our government. And like you mentioned, Dennis, we've got maybe close to 5 trillion of cash on the sidelines. There's a lot to say. And then once again, the interest rates, like the chart says at the very top, whenever interest rates are low, and right now there's really, outside of just maybe the longer term yields are starting to rise a little bit, like on 10-year bonds, but we know the Federal Reserve, the central banks around the world are staying very, very supportive of the economies. That again it's a good recipe generally. You want to be taking on risk generally when there's a lot of stimulus out there. And we definitely seen U.S. stocks do very, very well, even global stocks to a lesser degree. So I think it's tough right now. If you are an investor, stocks are kind of, I'm not going to say the only game in town, but they definitely are an area that is tough to go away from. If you think about it, if you go to bonds, you're getting bonds at very low yields, and maybe they even, some measures may say they're less attractive. It gets back to, you got to analyze both, and they're tough choices. When you go to cash, you're pretty much saying, I want to hunker down. And, I'm really not to get much, if any, return right now, given low interest rates. So I think it gets back to people are really trying to figure out if they are concerned about their risk level in their portfolio. You got to make some decisions about, do you want to, go more into cash and kind of sit on the sidelines? And it's a challenging situation, but I'd say right now it's tough to get too far underweight stocks, just given kind of the economic underpinnings, at least from the central bank perspective. And as long as we are continuing to move forward, which once again, we've seen it, Europe start to lock back down. So there is risk there for sure. I think it gets back to just understanding your tolerance for risk and making sure you're in the right strategy.
Yeah, and just a reminder, and we highlighted this in one of our written chats back in the spring, that just because Europe has a lockdown doesn't mean their companies don't do well. We highlighted SAP, again, not a stock recommendation, but as a company that has about half of its revenues overseas. So what's happening right at home is impactful, but not everything that's involved. And that is true for a lot of the big multinationals that are headquartered in different places in Europe. So let's go to the next slide. So we're running a little short on time, but Glenn, kind of run us through. This is sort of an interesting list of, what do you think is going to do better in a COVID-19 endgame?
It's definitely a challenging question. I think, as you alluded to earlier, with some of the technological changes and this techno-industrial revolution, the growth area has been a very attractive place to be in. And I think, not to say that's going to change. I think we're just a little bit concerned about some areas of that market running a little bit hot, but still an area that's got a lot of positive fundamentals. We talk about just areas that have been beaten down. Once again, you got beyond areas that have done really well, like growth, technology, you've got areas that just haven't participated as much. And so we're always looking on the value side of the ledger for things that might be a good discount and a good bargain right now. And so that does lead us to some of these areas we talked about earlier. Small cap stocks or smaller company stocks haven't participated as much the last couple of years compared to international stocks. And so, compared to large cap stocks. And so we're looking at that area as well as looking, maybe it's got some positive attributes. Some of the areas, once again, that are tied to opening up, whether it be the travel, leisure space, some of the areas that just haven't participated, like banks, for example, we're looking at all those, I think. And not to say anything right now is, isn't without fleas. Everything's got issues you want to make sure you address. We're just thinking that we want to make sure we evaluate what happened Monday and see if that is more of a prelude, maybe just more of a glimpse, better way to say it, in terms of what may participate better on the second half of the recovery. But you don't want to abandon some of the areas that have been working, because the technology and growth areas still have a lot of merit for sure.
Okay. Next slide. So consumer confidence and price earnings trends. What does this slide mean?
I think this really goes back to that narrative I was speaking about earlier, and how, really when you have sentiment that's upbeat and you're looking for reinforcing news and things, or you're just trying to justify why, stocks are where I'm allocated mostly to, and I'm looking for this to eventually recover. I think that's always bodes well. When sentiment's strong and you're upbeat, generally the stock market is doing well alongside that. So we're always watching for the kind of sentiment changes and kind of expectational changes. And so the problem is when you get surprises, and that's always comes out of left field when those happen, and that can take the market by surprise in terms of changing direction. But I think that's a good correlation chart to think about.
Yeah, and I think for our person moving the slides, the cat must have hit the back button. We went back a slide. Let's move forward. Yep, and one more. Okay, so here's another one of those equations.
Yeah, so here I think it kind of goes back to what we talked about a little earlier in the presentation. International stocks, we're trying to think about the prospects there. And once again, U.S. stocks continue to be a major part of people's portfolios. They tend to have a home bias, generally speaking, when you think about investors and where they're allocated across the globe. But once again, how things may come through as we start to get this relief, hopefully with a vaccine, better treatment, and start hopefully getting through this unfortunate period we're in. And then when you start looking at valuations and trying to judge, where do I want to allocate capital where I'm getting the most bang for my buck, and when I put money to work in terms of the earnings and the growth prospects, we do have to continue to consider international, given they do look much better values right now. And I think we want to weigh that against the economic underpinnings. And so we're not, once again, saying we're going to start rushing to international, but it's just an area we want to continue to understand and explore, just given the valuation differential. But once again, the U.S. area, just given that we're a melting pot, given that we've got just a lot of great growth engines here that we've already talked about, it's an area that's tough to compete with, and we just want to once again think about both sides, but be prudent and deliberate, and really lean into the data.
Yep, and again, just a good reminder that if we do have multiple viable vaccines in 2021, that is equally good for overseas countries as it is for our country. The fact is that the amount of money that has already been put into buying doses of these through Operation Warp Speed and the manufacturing facilities and some of those things, maybe we'll get a little bit of a jump on that. But again, what we're hearing overseas is they're going to be manufacturing at a pretty intense level over there as well. So again, we shouldn't think this is just a US phenomenon in terms of the COVID-19 relief. And so here's yet another one of those equations that translates to small US value stocks that you mentioned earlier, Glenn. And the fact that you put these all together and they make for an interesting picture.
Yeah, so very similar to the large cap space or larger company space, value has really it's kind of lagged across the U.S. Stock spectrum. And so when you think about value and you think about small caps tend to do well when the economy is recovering, and how they have lagged across the board, even more so on the value side of the ledger. I think that's another area that just piques our interest. And I think we're want to continue to look at these areas as we move forward that seem to have better valuations. Once again, when you look at future returns and investment results, usually your starting point matters. So when you have a good starting point from a valuation perspective, and assuming that you can let time and have patience to get through these volatile spells, then it's typically an area where you want to focus on in terms of relative value.
Yeah, in the past, we have featured the investment wisdom of some of the top investors of the last century, and starting point matters is on every single one of their lists. So that's a good one to remember. Next slide.
So Dennis, this really just shows kind of what we were just talking about, how we're looking at the Russell 2000, which represents smaller company stocks, versus the S&P 500 or larger cap US stocks. So basically, when the line's going down, you can see maybe around late 2018, where that little area is just past the green section in the middle of the chart, top pane. You see where it started declining, the red area. And what that basically says is that as that line's declining, small cap stocks are underperforming larger cap US stocks. And so we have seen a little bit of a trend in the other direction more recently. And so once again, along with the valuations, this change in trend is making us at least reevaluate things and think about, is small cap an area that has potential to, we want to lean in a little bit more to that area given some of the fundamentals.
So here's an interesting question from our audience. Many of these small value stocks appear to be kind of boring traditional businesses, and the small growth area are the companies that are doing exciting things that tie right into the techno-industrial revolution. So shouldn't the small growth area have equal weighting?
Yeah, I think you always want exposure. When we think about the style boxes, we call them, where you have, more growth type stocks versus value type stocks, and you have maybe stocks that kind of straddle the fence a little bit. You definitely want to have exposure to both. It's a matter of just if some kind of run hot for a while and get above their trend, usually the trend reverses at some point. Usually you have, periods where value underperforms, like has happened more recently, and then, growth outperformed for quite a while now. And at some point you expect that to reverse. And sometimes the value outperforms in bunches. You'll get a few years where you just get outsized returns on value, but then over a longer period, growth continues to take the baton and lead. So all we're trying to do is just recognize that, we want exposure to these companies that are really growing their earnings. Obviously, if you're a business person, you want to grow things and you want to be excited about prospects, but you also want to be cognizant of how much you're paying for that growth. And are you paying a premium for the growth? Obviously, that happened in the tech bubble in 2000, in the late 90s. You're paying more than you should have for the growth, and the growth didn't materialize. So you just want to be cognizant of the price you're paying and recognize there are going to be periods where, you can kind of pick up, we call it picking up the cigar butts. You're finding these things that are very cheap sometimes in value land, and not always, but you're just always trying to think about, am I getting a better value, and will that materialize more quickly once the market recognizes that you're getting that discount.
Well, and we should also remind everyone what we have said multiple times, that some of those old boring companies are tech enabling themselves, and the pandemic has actually allowed them to accelerate that process. And those tech enabling companies are every bit as interesting now as some of the actual purveyors of the technology that they're using. Okay, let's go to the next slide. So Glenn, what's our general COVID endgame which first of all, folks are probably liking that we're actually using that phraseology that 2021 may be the end game for COVID. What's the end game strategy?
Yeah, I think first of all, in this environment, I think you definitely, once again, want to understand. And we've had discussions with a number of clients. Understand if you're in the right strategy in terms of making sure the strategy fits your risk reward. And I don't think you want to make super big bets here. Now, obviously, you could have done really well by leaning into certain areas given the volatility in the markets. But I think it's probably better to, kind of hit for singles and doubles and not swing for the fences using baseball terminology. But I think you want to focus on, companies and investments that just have good fundamentals and can weather the storm. And you want to be diversified. I think that's always the first thing, is make sure you don't get too focused in any one area. This nuanced recovery has shown us your experience can be vastly different if you're only focused in certain areas. So I think making sure you got that good foundation. Then sure, if you want to explore into certain areas, we will lean into certain areas we think have better prospects than others, but I think we want to have that good core. And you want to think about the future objectives you have longer term. Are you on track to meet those with this type of a strategy? How much growth, how much income, or do you have enough, fuel in the tank, and are you leaning in enough to growth to meet if you do have, bigger objectives or bigger things you're trying to strive for? If you're in good shape, maybe you want to be more conservative and just kind of get more dividends and just kind of lean into income and take it a little more slow, steady, and stable. But the thread the needle scenario that Dennis mentioned, hopefully the needle is getting larger, and it's something that as we start opening up and hopefully get a vaccine, things will look much better. But there are risks out there we need to acknowledge. And I think we want to make sure that we have those core tenets of diversification and making sure we're in the right strategy. And then we can kind of continue to try to accentuate or either, shy away from areas that maybe we don't like as much.
Yeah, it has been our experience in any recovery that you generally have more things happening in a positive vein than negative vein, but there's always setbacks. There's always unexpected things that come into the equation. So 2021 ought to be a very interesting and eventful year. And we look forward to working with you all, updating your financial plans around how to make sure that no matter what events happen, that you are moving towards your future goals. On behalf of Glenn and our entire SFG team, I thank you for watching. A reminder that these are still being taped and on our YouTube channel, and you can view it at your leisure later. Our next session, our normal 2-week series would put us right after Thanksgiving. And unless something extremely large has happened in the world, we're probably not going to do an after Thanksgiving session, but it'll probably be the Friday after that. Thank you all for watching and have a great weekend.
Thank you.